Ideal Professionals video tutorials. In this tutorial, we're going to look at model 2, financial statement forecasting. The first step is to ascertain the problem. Second step, to look at the assumptions of the forecasting. Then the third step is modeling the strategy, then building our model, test our model, and step 6 is the uses of the model. So let's quickly take a quick review of the model 1. This is our historical income statement and balance sheet, and also our cash flow statement. So based on this is our income statement and this is our balance sheet. For which period? 1999 to 2002. Now the problem. You have been asked to prepare projected financial statement for GLS Limited for 2003 to 2006, starting with the historical statement for 1999 to 2002 for your forecast. The historical financial statement will be given to you in the DVD or sent to your mail. If it is not in your DVD, contact the number on your screen. Then, using the forecast, you use the assumptions in the worksheet, but make your model flexible enough so that a user can easily play what if game as indicated in the assumption. So let's look at the assumption. So these are the cash flow and the income statement and balance sheet. So let's close this. So based on this, now I want to project our income statement and balance sheet based using 2002 figure and based on our assumption. So these are the forecasting factors. Let's now check our assumptions. You can also open it with me. It should be in your DVD. Send to your mail. Assumption for forecasting model. So for the income statement, these are the assumptions. Sales will grow by 5%. You can take time out and study the assumption. 50% of sales, little better than historical. 9%, and so on and so forth. So you can just go through 2.1% of sales. And you also have other assumptions. An interesting one is the plug. What is the plug? If you check, is a balancing figure. That is, after getting our assets and liability, you now take the balancing figure to be our short-term debt. So it's a balancing figure. You can check video 6 for what we mean by the plug. So let's go to our projected based on the assumption. If you check the first assumption, for example, we say sales will grow at 5% based on the input from management. Sales will grow by 5%. So what's now our formula? We have already indicated 5% here. So for any formula, we start with the equals to sign. Equals to. So there's what we call absolute referencing. Let me take a review of relative referencing. Relative reference, the column will be changing, the letter of the column will be changing. For example, if the formula is F6 and F6 plus G6, relative reference, once you are now summing it up, as you are coming down to the next place, it will change it. Let's take a quick example of relative reference so that we'll be able to understand this one better. Let me open a new sheet to explain the relative reference. So for example, if I just say 40 plus 50, so if I now say okay, the sum, auto sum, will give me 90. Now if I now copy this formula to this place and I now insert the figure here, 30 and 10, so this is now A2 B2. Before it was A1 B1. So this is called relative reference. The row, these are our rows and our columns. So it will be changing the figures. Now assuming I just want to reference a particular cell, notwithstanding where I'm copying it to, the formula to, I'll use absolute. It's called absolute referencing. Absolute referencing. Let me to understand this very much. Even to change a particular, if you are inserting a formula, for example, if I want to reference, let me use another example. If I want to reference a particular cell and I want to just make sure that if I say this is 5%, for example, and I want to make sure that all these figures will be referencing just this one cell, that is C4. I need to use absolute referencing. Now, absolute referencing, you put a $sign in front of the column letter and in front of the row number that is behind it. Let's say, for example, I want to use absolute referencing is equals to, this is, I will now press my $sign, then I'll say I want to reference C4, I'll say C, then another $sign, then I'll say 4. So it's now referencing this particular, so I'll say 5%. So let me change this formula to A5 multiplied by, so that is 280. So if I now copy this, This one too is referencing C4. One is referencing C4. So that's absolute referencing. So let's quickly go back to our formula. So with that knowledge and to reference, you can also press F4, the function key F4 for absolute reference. So in our particular formula, we want to increase our sales by 5%. So now just press equals to, then we say we are referencing 2002. That is E6. Then we say multiply. Then now open our bracket. 1 plus shift and equals to. Then we say our dollar sign. Then we have our J. That's not for our cell. This is J6. Want to reference 5%. Then another dollar sign 6. Enter. Okay, I need to close the bracket. Yes. So I was close the bracket. That was why I was giving me a message. So once I copy this from 2004 to 2006, and just drag. So I've copied. You notice that everything is referencing J6. Now, coming to cost of sales, 52% of sales. So we will just say is equals to F6. This is S6. We are referencing the sales for 2003 multiply by our dollar sign we are referencing our J7, that is 52%. To get dollar sign, you press shift and number 4. With our, you can copy this formula across. That is this minus this. So this is relative referencing. So I don't want, I can just say without formatting, so that. So the next thing is is assumed to be 29% of sales also. So we just say equals to F6. That is our sales for 2003, and multiply it by dollar sign J, dollar sign shift and 4, 7. Okay, I want to reference 29, so that will be 10. You selected it for me. I'll say enter. So I can now copy it across. I can use another way of copying. I just say copy, and I will now use shift, like this, and say enter. Then to get my depreciation, I need to first compute my accumulated depreciation, because depreciation depends on the depreciation, the fixed asset. The fixed asset. So let's go to the assumption for the fixed asset. Okay, in the depreciation I told that 8% of gross PP and E. So what's our gross PP and E, that is 11, will grow 11% per year. So that means C is equals to this one, that is E33 multiplied by open bracket 1 press plus, open another say dollar sign for absolute referencing, J, another dollar sign, say 33. Then we now need to close the bracket. Say enter. So you can now copy it across and just drag with my skinny black plus. So now based on this, I can now compute my depreciation. So I'll now say depreciation is equals to F33 multiplied by F33 is my gross PP and E for 2003, dollar sign, say J, and that dollar sign 11. See enter. You can now copy it across. Then I do our net income. This is our net income. That is minus 0.7% of sales. Now be is equals to F6 as our sales for 2003, then multiply by J 12. So you can now copy it across. You can now copy this. So it's giving me some lines. So I would now say without formatting. Without formatting. Then our interest income. The assumption is calculate based on average balance and interest rate that was specified later. So our formula is equals to minus, because negative, now absolute referencing, dollar sign J, and the absolute reference 15, then now multiply it, open our bracket, E 27 and F27. plus F27. So I've not computed F27, so I need to do that, but notwithstanding, it will still give me some figure. It will still give me, so I can now come and, so what's my assumption for cash and marketable securities? That is 2.1% of sales. So I can just say is equals to F6 multiplied by absolute reference $sign J27 J absolute $sign again 27. Okay, I selected it. I'll say enter. Then I can now copy it across. So it automatically adjusted my interest income to 3.5. So I'll now say there's something that's missing here. I'll say divide by 2 because average. Say enter. So I can now copy across. And the next thing is now my interest expense. We check the assumption for interest expense. We have for short term, and remember that the short term debt is our balancing figure. Then also the long term debt remain unchanged at 13.5 million. Then so you can just say let's now insert our long-term debt, that is 13 long-term debt interest, long-term debt comma interest expense will remain unchanged at 13.5 million. Let's now look at the long-term debt. Long-term debt remain unchanged at 2002 level. So we say okay, that means this remain unchanged. You can just drag it across. So without formatting. Okay, so you check the assumption for short-term debt also. Then short-term debt, so we have the, so we can now insert our formula equals to then we say $13.5 million. Remember that everything is in millions. You see plus say $, 16 multiply by, open our bracket, E44 plus F44. I'll close our bracket, divide by 2. Something good about it is that you can always design your the way you want it. You now drag it across. And you can now copy this and just say, let's drag it across. I don't want all these lines. Just save without formatting. So our income tax, that 35% of F17, let's say, is equals to, as usual, F17. I just click on it, multiply by absolute reference J, absolute reference 19, selected, enter. Now copy it across, and the next one too can be copied across. You can now have our dividend is equals to, that's 40%, F20 multiply by $, J, $22, selected, enter, copy across. Now copy this one also across. Then for our current assets, we have done the one for cash and market securities. So account receivables, that's 8.5% based on sales, and based on sales. So you see is equals to sales that's F6 multiply by, that is absolute reference J, absolute reference 28, enter, copy it across. Same thing again. Then absolute reference about F6 sales 6 multiply by $J, then $29, copy across. The next one also, see, is equals to F6 multiply by absolute reference J, absolute reference 30, enter, copy across, just drag it. Then now copy this also, then now come to accumulate depreciation. Assumption is calculate from others, okay. So our accumulated depreciation is equals to our beginning depreciation plus the beginning accumulated depreciation plus the current year depreciation. So now let's say is equals to, this is the beginning for 2002 plus our depreciation for the expense for the current period, that is for 2003. You say enter, that's 509. You copy it across. So you can now use this formula also, that is this minus this. Then for other current assets, hope you are enjoying the way I'm doing it. You can always try it on your own. That's why the worksheet is available, so that you'll be able to manipulate and do the what if game and change as much as you like and assume what you like. So for our other the other non-current, we grow 10% per year. Let's say is equals to E37 multiply by, because growing, you say plus 1 plus dollar J dollar 37. Now close my bracket. No completion at all across. So we now have the total also. We now come down to our liability. Account payable, that is 6.1% of sales, is equals to, our sales is F6 multiplied by copy it across. Remember that the short-term debt is our balancing figure, so let us leave that and compute the others. So once everything has been inside, then we now come back and talk about the short-term debt, because short-term debt, there are some settings and some options, Excel options that we need to that we'll talk about when we get there. So let's quickly look at the others. So other current liability is F6. Okay, let's say is equals to F6 multiply by absolute reference J45, copy it across. You now add this formula also, sum deferred income, our deferred income is 1.4% of sales. That is equals to F6 multiplied by 49. Then copy it across, and other non-current liability. Non-current liability, that also is equals to F6 multiplied by $sign, that is J50, selected, enter, put across. Now copy this formula, drag it across, our paid up capital is the same, copy it across, now retained earnings, that's equals to F6 plus F20, FE54 plus F23, E54 plus F23. Now copy it across, then now copy this formula also, then copy this, let me now save, because it's always good to save as you work. Save as you work. So now let's now talk about this short-term debt. This short-term debt is a circular reference. The answer is depending on some other result that is also related to the answer. What am I trying to say? The short-term debt is the plug that balances the balance sheet. It must equal the difference between the total asset and all other liability and total shareholder equity. So which means circular referencing. So you can read more on circular reference. We talked about it in our previous videos also. So we need to come to Excel option and activate. You now come to formula. you now activate, you now enable iterative calculation. So make sure it's enabled. Once enabled, then say okay. So with that, we can now enter our formula. Notice all these balances. Just take one moment and notice the balances. Notice the balances. Image will be bold. See that for sure it's not balancing. So we now say okay, is equals to F40 minus F55 minus sum, open bracket, F48 to F50, open bracket, minus F43 minus, you can see how it's highlighting F45. Then we need to now see enter. You can now see that this is balancing 1383.4, 1383.4. So let me now copy the same formula across. So everything is now balanced. Notice that it's also depending on this depending on the interest, depending on F44 and E44. So this is depending on this also. So everything has now changed. So it also adjusted our retained earnings. So to now compute our projected cash flow, all you just need to do is, because all this has been linked to that particular reference sheet, so we just say highlight everything, because our balance sheet has balanced, so you have nothing to worry about. You just say copy, then now select all this, and say paste. So that's pasted everything. Escape. That's pasted everything. Now let's now confirm whether it is balancing. It balanced. Balanced. This and this are now the same. So that's how to test our model. We have tested our model by make sure that our projected balance sheet balanced after using all our, based on our formula that we use to making the short-term debt our plug, that is balanced figure, and based on all our assumptions, then we also see that because our balance sheet has balanced, so our projected cash flow statement also balanced. It's already linked to the sheet. So our cash flow, you just copy the formula from here and just say it, and because we have already created for 2006 2003 to 2006 in our balance sheet. So you can always use your assumptions and use different figures, and with this you can make a lot of money by building cash flow statements for companies, for individuals, and just setting your assumptions and using Excel to compute everything automatically. You can make, now what's the use of the model? You can make the model even more flexible. For example, here we can assume that the growth rate or ratio of sales remain constant for all the 4 years. We could easily set up 4 different forecasting factors. These are forecasting factors. We can now say, okay, 4 different forecasting factors for the 4 different years in the 4 different columns and use them in the model. Writing and copying formula, using them will be easy. However, you should not get carried away with building in additional flexibility. It generally requires coming up with more and more assumptions, and beyond a certain point, this assumption can just become a number game, because our ability to see into the future in details is quite limited. You should always try to use the minimum number of assumptions and not the maximum number. We can also build into a model like this certain decision rule and constraint to see what the statement will look like. So that is our cash flow and income statement. Model 2, financial statement forecasting. We talked about the problem. That's to forecast what we have: historic balance sheet and income statement and cash flow for 1999 to 2002. So we now forecasted 2003 to 2006. Then we also used our assumptions, different kind of assumptions. We also modeled the whole, and we built our financial statement, and we tested it that everything is balanced. Also talk about the flexibility. I hope this has been informative for you. I want to really thank you for viewing. Questions and observations, you can always contact the number on your screen or check my website. Thanks.